cost would be well received by consumers, but bad for shareholders who are, after all, the owners of the corporation in the traditional sense that they control the corporation. The CEOs who proclaimed corporate purpose in the Business Roundtable statement are not the owners of the corporation. They are employees appointed by shareholder-elected boards. A CEO announcing that their shareholders are no longer in charge is not far from a government official telling the American people that they are no longer in charge. So who are the shareholders? Most of the benefits of strong stock returns accrue to U.S. households. U.S. households own 38% of the U.S. stock market directly, and most of an additional 28% of the market through mutual funds and ETFs. And then U.S. pension funds own another 11% of the stock market, 11% of the stock market. The benefits there also accrue to households. And equity ownership is broad-based. 53% of all U.S. households own publicly traded stock. When you add on households that don't, but are relying on a pension, or own a private business where your principles also would apply, or non-residential real estate, over 68% of households are in some sense shareholders. So what do shareholders want? Well, while I sense that other witnesses here want some authority to prescribe what firms should do, I would contend that Milton Friedman in 1970 basically got it right. He said shareholders want, quote, generally to make as much money as possible while conforming to the basic rules of the society, both law and ethical custom. So under shareholder capitalism, executives have a strong incentive to make ethical decisions and plenty of leeway under the business judgment rule to do so, even if it doesn't maximize the returns on the company's stock in all cases. Regarding conflicts between short-term and long-term value, more than 80% of companies that do IPOs in the U.S. have negative earnings. Yet they raise hundreds of billions of dollars a year from investors, plus the venture capital referred to by Mr. Alexander. So it's hard to see excessive short-termism here. Still, in case of conflicts, the solution is simple. It is to structure executive compensation to reward long-term performance. It is not to give managers free rein to make decisions in the interest of any stakeholders they want. Of course, some shareholders may and do have a taste for investments that achieve non-financial goals. Chairman Beyer, your description of this hearing says that this hearing is supposed to, quote, examine the rise in recent decades of shareholder primacy, unquote, but the hearing really should be examining the erosion of shareholder primacy. Over 33% of total managed financial assets in the U.S. as of 2020 are now in sustainable investments broadly defined. This is the new phenomenon of recent decades. Now, if shareholders want to achieve social goals, even at the expense of financial ones, should companies act accordingly? Yes. But the difficulty comes if there is lots of passive capital, such as in the massive market tracking index funds that many Americans own in their 401k plans. Large numbers of smaller investors just want a good return on their investments. Meanwhile, powerful managers of the index funds they hold impose ESG on corporate America as they vote on behalf of trillions of dollars of other people's money. And investors may be at risk. The surveyed evidence in over 1,000 papers on the performance of ESG investments in public markets is quite varied. In my own work on private markets, I find that preferences for ESG are related to significantly lower rates of return. In 2020, the Department of Labor protected investors from arbitrary actions in the name of social responsibility when it limited the extent to which ESG funds can be offered in 401ks and other plans. The Biden administration's lack of enforcement of that rule and the new proposed ESG rule of fall 2021 threaten to undermine that. In many cases, the majority views of the American people do not even line up with the received wisdom of ESG. For example, Gallup polls from last year show that only 39% of Americans want less emphasis on producing energy from oil, and only 19% want less emphasis on producing energy from natural gas. That's not good support for shaming companies into pursuing these actions. Finally, it's misleading to focus on bad examples without considering the good of the entire system. Over the past 50 years, real per capita GDP in the United States increased 132% to $64,000 per person, the highest among all countries with a population of at least 10 million people. Since 1959, incomes for the bottom fifth of the income distribution increased by 262%, the highest of all income quintiles. Those are the fruits of shareholder capitalism. In conclusion, the focus now should be how to protect regular investors from the potential financial harms of arbitrary decisions under the guise of ESG and financial responsibility. And for fund management, we should return to a default of shareholder value maximization within the bounds of law and ethics, unless an individual shareholder actively specifies otherwise. Thank you very much.
Dr. Rao, thank you very much. We'll now begin with questions for our witnesses, and I will begin with Dr. Palladino. Proponents of stock buybacks have argued this practice serves the stock market by moving capital from firms that have no use for it into companies with a higher need for new funds. Why doesn't this hold true, in your opinion?
Thank you very much for the question. That's a great question that I'll break into two parts. The first is what I mentioned in my testimony. The argument for stock buybacks often is that it is a way to efficiently move financial assets or capital from a company that no longer needs it to other companies. But when we look at examples like, for example, Amazon, that just announced $10 billion in stock buybacks this past week, and we look at the fact that Amazon workers have been protesting and organizing for decent living wages for years, we see there's availability for investment in the workforce. When we look at Exxon and we see that they have invested very little in low carbon transition, we see that there's opportunity for investment. So I look at the opportunity cost as critical. The other answer to your question is that we actually need more information about the private markets to understand the flow of funds that go from an operating company that repurchases stock to an asset manager and then back out into the markets. We know that net equity issuance has been negative for the last 2 decades, meaning that publicly traded companies are issuing less stock than they are repurchasing. We need more disclosure and data for the private markets to fully understand the flow of funds, but I believe that these arguments are mainly misguided. Thank you.
Thank you very much. Ms. Samuelson, proponents of shareholder primacy contend that shareholders own the company. We just heard this from Dr. Rao. And yet you've argued that the corporations are actually owned by the corporations themselves. Can you expand on this and why we shouldn't think that the shareholders, through their 401k or whatever, own the corporations?
The corporation owns itself. When the corporation legally incorporates, it becomes legally a fictitious person. And the person owns its assets and liabilities just like any of us do. The shareholder has a certificate of stock. What that certificate of stock enables the shareholder to do is to vote for the board of directors, an critically important right. It gets to do things like weigh in on whether or not the executive is appropriately paid. And then, of course, it can put up votes on the ballot. It can ask, at the annual meeting for certain things to be taken up and considered. But it doesn't add up to controlling or running the corporation as might have been the case if we went back 100 and some odd years in terms of how it was structured then. So the situation has changed a lot. And if we kind of look at the result of the incredible dependence on the shareholder as kind of the organizing principle for the corporation today, we do end up with things like, I'll use another example. She talked about Amazon. I'll talk about Target. Target got a lot of great press a couple of weeks ago because it announced that it was going to be doing about $300 million of investment in its employees, in some wage increases in targeted parts of the country, greater access to health care. We can debate whether or not those things add up to much, but if you kind of roll back in time, 6 months ago, this is $300 million investment announced in their employees. 6 months ago, they announced $15 billion of share buybacks. If we go back over the last 10 years, something like 93% of profits have been returned, or I don't even like to use the return because I'm not so sure they were necessarily due to begin with, but were paid out to shareholders, 93%. The factor that is most important in this environment is what we're doing to reward executives, and the executives today are being paid in stock as well. So all of this is consistent with their worldview and what they're being paid to do. But no, the shareholders do not own the corporation. They own shares of stock that come with some rights. The last thing I'd just say is that if you look at the say-on-pay votes, they correlate with the stock price. As long as the stock price is going up, say-on-pay votes largely go with saying the pay is fine. It's only when the stock price is going down that someone may raise an objection, or the shareholders raise an objection to how the CEO is paid. So the system is kind of reinforcing of where we are now.
Okay, great. Thank you, Ms. Sim, very much. Let me now introduce Senator Lee for his questions.
Thank you very much, Mr. Chairman. Yeah, Dr. Rao, I'd like to start with you. We've heard a lot today about reform proposals and critiques of the way the market works. I am concerned that in many cases when the federal government gets involved, in order to make the world appear to be a more equitable place or to enhance the perceived fairness of the marketplace, we can end up not only not achieving that, but having the opposite effect. It's particularly dangerous in an environment like this one, in which you see that inflation, just what we're experiencing today relative to a year ago, has made it so that the average family in Utah is spending an additional $582 a month, every single month, just on the things that they already have to buy, just higher prices on the things they've already got to buy, relative to a year ago. This is about $7,000 a year that they're having to cough up just to buy the same stuff that they bought a year ago. Gas prices are spiking, well over $4 a gallon, and just in this last week alone, the prices at the pump in Utah reached their highest levels ever on record. And so if we do these things right now, and we try to do something like pursue the SEC's current plan to mandate climate-related ESG disclosures, I fear that those would undercut the very interests that they're supposed to serve. These sorts of things inevitably hurt the poor and middle class. They do so in a few ways. Number one, I think they tend to entrench market incumbents, well-funded market incumbents who are in a better position to absorb the compliance costs that startups wouldn't have to deal with. They also have superior access to, you can further degrade the ability of a startup to gain access to capital when you do this. And then, but across the board, you're increasing compliance costs, and so the cost of goods is going to become higher, and made higher still by the relative lack of competition from new entrants into the marketplace. So tell me what your perspective is on this, on whether mandatory ESG reporting, how that might impact ordinary Americans.
Well, thank you for the question, Senator. I think there's little question that ESG actions, including both reporting and ESG activism, have reduced production of oil and gas in ways that are impacting regular Americans. ExxonMobil lost 4 board seats last year to engine number 1, an ESG activist fund, and Chevron's board forced them to commit to reducing their indirect emissions, meaning the emissions from people buying their product. And there's been a litany of sustainability statements from many of the energy companies that they've released recently, I sense, under ESG duress. BP's commitment to decarbonize involved a promise for no new exploration, a decline of production of 40% by 2030. Other oil and gas companies have made similar statements, and so this must be affecting production. And in fact, one other point, which is the companies that are not subject to as much ESG pressure because they are private, as opposed to publicly traded and may not be subject to as many regulations, they are now the ones who are stating that they're going to do the most, the majority or more capital expenditures this year, 2022, than publicly owned companies, particularly in the shale sector. So a little question in my mind, ESG pressure has been substantial and has had effects on production, driving down quantity and driving up prices.
All right, thank you. That's very helpful. It seems to me the last thing we ought to be doing in the name of making for a more competitive environment, an environment in which upward economic mobility remains part of the American dream. Last thing we would want to do is adopt a series of policies that will further entrench elites, those who are already wealthy and well-connected, making them wealthier and more well-connected altogether at the expense of poor and middle-class Americans. Tell us a little bit from the investor standpoint, a little bit about how you might create risks that would go to poor and middle-class Americans who are today's workers, tomorrow's retirees, those saving for retirement or saving to buy a home or what have you. How might that be affected by any system that would prioritize political, social, environmental goals above and beyond those required by existing environmental laws, that is, instead of growing their company and answering directly to their shareholders?
Well, Senator, in order to implement those requirements, the money has got to come from somewhere. And so that means it either has to come from customers in the form of higher prices that consumers are going to pay, or it would have to come from workers in the form of lower wages that we paid to workers, or it's going to come out from shareholder returns. And, while there's been a lot of talk of how much the top 1% owns of the stock market and so on, the fact is that we have a society where there is broad ownership, where many, many Americans, 53% of Americans own some stock, and a lot of people are relying on the stock market for their retirement. And it seems rather problematic to require companies to do things that would reduce the returns that individual investors are expecting and are relying on in the interest of goals that are not actually part of the law. And it's an interesting question to wonder, why are these requirements not part of the law? I think part of it is because these requirements are just not very popular according to polling data. So bottom line is that whenever you put these types of requirements on companies, it has to come out of something. There are trade-offs, there are conflicts, there are complex trade-offs, and the market system has done a good job of managing these over many decades.
Thank you.
Thank you, Senator. In the absence of the chair, I'll recognize myself. Mr. Alexander, you've noted how shareholder primacy is not the only doctrine that companies have used in the past to inform their operations, because it's become more standard recently. Can you tell us how companies operated before shareholder primacy became the dominant doctrine, and how modern companies might take a different approach that would better align their incentives, in your view, with what's the common good?
So I would say that, thank you for the question, and I would say that, in some sense, there's been a pretty direct line of shareholder primacy throughout the 20th and 21st centuries, as shareholdering became more diffuse, as there was more separation of ownership from control. And the real issue has been in sort of, what does it mean to sort of represent the residual risk bearer, the equity holder. And I think an important thing to think about as we talk today is that the question of shareholder primacy or not, or how we practice it, is not a question of whether we practice ESG or not. ESG as practiced today actually buys into the shareholder primacy thing. If you think about the ExxonMobil, the engine #1 campaign last year, that was a campaign based on sort of ESG principles, shareholders saying, the company hasn't done a good enough job addressing climate change issues. But the point they made was that the company had misallocated capital in anticipating the switch to more renewable, and that therefore they had done poorly for their shareholders. Engine #1 is a hedge fund that was concentrated in company stock, and they just wanted the company to do better, and that was their theme. They were not asking the company to make sacrifices in order to benefit, the greater good. The question I think we're wrestling with is whether, when a management team says we're going to put the shareholders first, are they doing so in a way that externalizes costs, that hurts society as a whole, that hurts the market? And in my mind, that's not a good practice of shareholder primacy, because it's very likely that your shareholders are invested in other companies who are hurt when the economy's hurt. Thank you.
I was sort of asking about whether the perspective of companies has changed with respect to shareholder primacy over time. Do you see that it's been different?
So I'll confess to not being enough of a historian to really answer that question well. But I don't think, in the New Deal era, this question was really wrestled with. There was the Burley-Dodd debate that asked, are companies run for the benefit of society, or are they run for the benefit of their shareholders? And I think what happened post-war was there wasn't a conflict. Companies were able to pay their employees well, do well by their shareholders, and they just weren't thinking about, I would say, some of the debts that they were incurring to the future in terms of what was happening to the environment, what was happening to society. And what happened, I think, in the last 50 years was as we approach certain planetary and social boundaries, management had to begin focusing on the real trade-offs that existed, and that's what sort of called the question.
Ms. Samuelson, when we talk about the role that shareholder primacy plays in global climate change, how do you think that companies can move beyond paying lip service to sustainability and commit real resources to help fight that particular cause?
Well, these are definitely created, but can I steal a little time to respond to your earlier question?
You can have 45 seconds.
When shareholder primacy really took off, it was in the early 80s. And what happened is, yes, there was this Milton Friedman-esque idea that, we needed to put shareholders, we needed a single objective function. We needed to wake up corporations, and there was some truth in that, perhaps. But what happened is in the 1980s, we started connecting the CEO pay back to stock. Right. Silicon Valley loved this. They could hire people cheap and promise them stock, and things really then began to take off. It also happened in 1993 when Clinton put a $1 million cap on what could be deducted of the CEO's pay, and that then really took off. Stock options really took off at that point. You really got to go back to that point as when this whole thing really started to launch and really took on steam.
All right, maybe we could explore that later. We'll turn now to Mr. Schweikert for 5 minutes.
Thank you. Just for the fun of it, what was the second half of Milton Friedman's sort of treatise from, what was it, 1970? So as long as it stays within the rules of the game, which is to say, engages in open and free competition without deception or fraud. We always seem to sort of forget that second half of the 1970 treatise from Milton Friedman. I actually have a slightly different view. In many ways, this hearing actually bothers me from the standpoint of we should have done something much more global with considering what's going on in the economy and our world and our right now than this sort of soft nationalization of corporate boards, which is functionally what it is, let's be honest. Sorry, without wearing my glasses, the last witness just said something that actually I think rings quite true. Much of what's going on that the left considers bad is our fault. We've made it so expensive that many companies are choosing to go private. In many ways, would you take a company public in this environment right now if there's enough liquidity in the market to stay private and not have to deal with this sort of stuff? Our tax policy. In many ways, we drove this by our own tax policy. And for Mr. Rao, I really want you to touch on two things, because there's one thing in your written testimony about rates of return, how many companies really don't have a rate of return, but people are willing to invest in it because of it's a new drug, but we're not going to see it for 15 years, or sort of that hope. And also touching on the fact of the incentives, we have so screwed up the market, how few companies come public today to be available for society to invest in. And we're creating a world where the haves, through family offices, through others, get to own shares. But what's available to the public keeps shrinking in many ways because what we in Congress do, which is making it miserable and difficult and expensive to go public.
Thank you for the question, Congressman Schweikert. So yes, there's clearly been a major trend over the past couple decades towards companies remaining private. And going public introduces a number of, has always introduced various governance requirements, disclosure requirements, and now with the advent of the ESG requirements, and now with the SEC potentially getting involved and potentially regulating what those requirements would be, that adds another layer on top of this that adds a further disincentive to go public. And as firms not going public have major consequences. In a 401k, individual investors don't have access to private companies. They have to invest in publicly traded companies. And so it's incredibly important that we have a robust setting where Firms are going public and where individual investors have access to invest in them. And it's also important to ensure that individual investors know that the mutual fund managers who are managing their money on behalf of them in index funds, just when you buy, when an investor just, checks the default option in their 401k invested in the stock market broadly, that those investors are going to be concerned with maximizing the returns that the investor can get, not with some considerations that are non-financial that the individual investor may simply not share.
Okay, Doctor, if I came to you right now and said, we don't like some of the corporate governances, wouldn't the much more egalitarian solution be to create an environment where you minimize these sort of oligopolies, which is functionally what we've created in our corporate world, whether it be airlines, milk, banks, let's face it, through regulatory constructs, we've made monster companies to actually create an environment where lots of disruptors, whether it be their business model, their business plan, their technology, but it's time to actually have a disruptive business environment where if you want to invest social good, that's the model you choose. My fear is we're trying to change our own sort of almost oligopolic, if that's a word, model right now, instead of doing a much more egalitarian, holistic solution of, screw it, we want lots of competition out there.
Well, I'll just say regulation creates, as you say, benefits for incumbents who are able to make the investments necessary to comply, and it harms competition. And more competition means more price competition for consumers and the products that consumers buy, and it's better for the end consumer at the end of the day.
Thank you for your tolerance, Mr. Chairman.
Thank you. I'll go to Mr. Estes.
Well, thank you, Mr. Chairman, and thank you to all the witnesses for joining us today. I think many Americans are right to be alarmed at the rapid increase of political activism and bullying among our nation's top corporations. Rather than focusing on the well-being of their employees, customers, and shareholders, there have been a notable number of examples of large companies using their market power to push far left political causes at the expense of everything else. Predictably, this has led to discrimination against hardworking families who disagree with those causes being pushed. And whatever your political views, I think we can all agree that it isn't good for American capitalism to have our most known brands bullying certain Americans for holding mainstream beliefs. I believe many of the current proposals from the left involved a stakeholder primacy would make this problem even worse by mandating that companies partake in these unfair activities. When it comes to the different metrics being proposed, like environmental impact or some of the ESG scores, I'm concerned about how these will be implemented. I mean, the 53% of the U.S. households that own publicly traded stock are best served when companies focus on building good companies that are profitable, not by getting investments into profitable companies through ambiguous ESG scores. To recover from our current economic catastrophe that the Democrats and President Biden have steered us into over the last year, we need permanent policies that encourage active participation by U.S. investors to drive economic progress rather than divisive policies like stakeholder primacy that would put American families last and special interest groups first. Dr. Rao, do you think stakeholder primacy would lead to companies implementing private ESG scores for customers, maybe similar to a credit score, but instead of rating creditworthiness, rating a person's or customer's so-called ESG risk?
Thank you very much for the question. That's an interesting idea. Just so I understand, are you referring to the idea that companies would then rate their customers on alignment with certain values and then would potentially exclude or discriminate against those customers?
Or avoid doing business with them at all if they didn't match the score that maybe come back to reflect on them?
Well, that's an interesting idea, and it would be certainly a very, very dangerous trend if that were to happen. The idea that a company would discriminate against an individual because of the political beliefs that they hold would be quite concerning. One place where you could imagine that happening at another level would be also with suppliers. I'm going to choose to buy only from companies that sign on to a certain statement of ethical values that I also agree with. I think this is all very detrimental to the forces that have made the United States economy, the strongest economy in the world, and one that has also delivered extremely broad-based growth to after-tax, after-transfer incomes for individuals, and it also would be extremely disturbing. Now, I would wonder if such practices would actually be thought of as being legal. Is a company allowed to discriminate against a customer? I don't know. I would have to turn to legal experts on that, and at least one thing that can potentially constrain companies is the law.
Do you think that, U.S. companies could use ESG to maybe discriminate against Americans in general for like a political belief or their affiliations?
It's not impossible. It seems that one could have a situation where companies could attempt to only work together with people who sign on to certain values that they hold on the front of ESG, and if they did so, it would be quite a disturbing development. I will say one constraint would be that do companies really want to give up potential customers? Are they willing to hold on to these beliefs so badly that they're willing to give up potential customers? I don't know. I mean, one of the forces that has produced good ethics from companies in many settings is actually the force of knowing that they want to have they want their product to be bought by as many people as possible, and they want to have a good reputation among the American public in general. It's pretty costly to shut off the potential customer base by some very large percentage by shutting off people who don't agree with some of these principles, which, as I mentioned in my testimony, it seems to me that there are many of these inherited wisdom ESG principles that are not actually well supported in polling data.
Yeah, I mean, we've had a lot of discussion lately about banks and others that may not do business with certain companies or certain industries. And, at the end of the day, stockholders own the company, and whether they're moms and dads or retirees or pensions, and they deserve to be able to manage the productive use of their property. So thank you, and I yield back, Mr. Chairman.
Thank you. We'll turn now to Senator Cruz.
Thank you, Mr. Chairman. Welcome to each of the witnesses. Dr. Rao, more and more we're seeing a dangerous shift in America where woke corporations are acting as the political enforcers for partisan Democrats. And we're seeing more and more CEOs weigh in on political matters and use their corporate power to try to punish anyone who doesn't agree with a radical policy agenda. In your judgment, is it in the shareholders' interests for woke corporations and their CEOs to use their market power not to provide the goods and services the company is focused on, but instead to enforce a partisan political agenda?
Well, I think this is a classic case of what we call in economics a principal-agent problem. The shareholders are the principals, and they hire the managers, CEOs, as their agents to act on their behalf. This is no different in a startup or a private company. People on the committee have business experience starting their own businesses. If you hire a manager, that manager is your agent and working on your behalf. And so when you have a situation where the manager, the CEO, the executive, who does not own the company, who is an agent of the owners of the company, is taking actions to impose their own political agenda, then I think that is a major failure of governance and a major failure of accountability. And I think that is actually quite a dangerous thing.
Well, I agree with you, and there's not only a principal agent problem with the shareholders versus their woke CEOs who are not actually focused on increasing shareholder value, but there's a principal agent problem with regard to the voters, because these CEOs are not accountable to the voters. And in my experience, most of them are profoundly ignorant about the topics they're trying to regulate, that they do so as a mild virtue signal without even doing the barest of due diligence. I can tell you major banks that tried to legislate gun control by saying we're going to cut off financial services to companies either that don't sell firearms to people unless they're 21 and over, which is not the law, or that ban so-called assault weapons. I can tell you I had the senior leadership of a bank that insisted it was going to cut off capital to anyone selling assault weapons. And I asked the leadership, I actually asked the person who designed the policy a simple question: what is an assault weapon? She had no idea. She told me it was a machine gun, which is not what an assault weapon is. And paused for a second to think that she's writing a policy without even knowing what the hell she's talking about. Likewise, there were numerous corporations that took political positions about election integrity laws in Georgia and Texas. The CEOs of one of those corporations sat in my office, and I asked a very simple question: name one provision in the bill that you denounced as racist. Name one provision that's problematic. CEO couldn't name a single provision. Had put out a public statement saying it was racist and had no idea what was in the bill. Dr. Rao, do these CEOs, do these corporations have any meaningful expertise in political matters? Is there anything about the companies that actually reflect the democratic wishes of the electorate?
Well, on the first point, if I might say, at the Stanford Graduate School of Business, we do attempt to give them a broad education. Now, on some of the specific matters at hand, and also what Americans believe, I think you've really there identified one of the main problems, which is that, you know, I suspect that part of the reason that gun laws in America are not different from what they are now is that in the latest Gallup poll from 2022, 41% of Americans were satisfied with U.S. gun policy and 13% were dissatisfied but wanted less strict laws. So that's 54% of people who want either the same degree of strictness or less strict gun laws. So plus, you know, given the Second Amendment of the U.S. Constitution...
So and let me ask you briefly, just because time's expiring, what can Congress do, or what can federal regulators do to ensure a robust system of shareholder capitalism in which shareholders can expect executives to actually focus on the bottom line rather than engaging in political adventurism and pursuing their own partisan agenda at the expense of shareholder value?
Well, I'd say two things. First of all, you know, step back from mandating ESG-type regulations or trying to regulate that sector in a do-no-harm kind of way. But secondly, the government should also be considering actions that could protect shareholders from their agents, you know, owners of, you know, index mutual funds, from their agents voting against shareholder maximization without the explicit permission of the shareholders. And I'll tell you, there are many shareholders out there, or just regular owners of 401k funds who are relying on index funds, the performance of the U.S. stock market for their retirement. They are not interested in CEOs pushing their personal political agendas. They're interested in getting a fair return on their investments.
Well, thank you, and I think those are good and helpful suggestions.
Senator, thank you very much. Now begin a second round of questioning. And forgive my absence, I had to go vote for myself and 4 other members by proxy, people affected by COVID. Let me begin, Mr. Alexander. You had written that the assumption that the interests of shareholders in the economy are best served by using the financial returns of a company as the sole measure of success. Why is that not the sole measure of success?
Yes, thank you for that question. The reason it's not the sole, and again, I differ from some of the other witnesses here today in that I actually don't have an issue with running a company for the benefit of shareholders. I just would say shareholders are not benefited, shareholders with a broad portfolio are not benefited when each company within that portfolio struggles to increase its own bottom line without regard to the effect of doing so. It's just a category error. If you want to have a portfolio that performs the best, you don't want each individual company within that portfolio trying to be the best because they'll interfere with one another. There's an economist, Thomas Schelling, who won a Nobel Prize for this idea, the ecology of micromotives. It's just like when you drive, if everybody in a city wants to get to their destination as soon as possible, you don't just put them all out in their cars on the street and go get there as soon as possible. You establish rules of the road and stop signs and stoplights and all those sorts of things. And it's the same thing. If a company, attempts to maximize its value, by, paying its workers significantly less than a living wage, and that leads to poverty and, poor social determinants of health and things like that, it's going to drag the economy down and when you drag down the economy, you drag down the performance of a portfolio, because basically a diversified portfolio, relates, the performance of a diversified portfolio relates directly to the performance of the economy. And what I would also say is, I've heard some questions today that sort of talk about putting handcuffs on corporations. Let me just say that what I would like to do is remove the handcuffs from shareholders. Currently, disclosure from the SEC is built around one idea. Let's look at ESG matters, social and environmental matters. Will a social and environmental matter affect the performance of a company? But how about asking the SEC, giving shareholders information about how a company's social and environmental performance affects the economy and thus the other companies within that economy? Swiss Re estimates that if we stay on the carbon trajectory we're on, rather than a Paris-aligned trajectory, then the GDP, global GDP, will be 10% less in 2050 than it would otherwise be. Swiss Re, this is not a radical institution, one of the largest reinsurers in the world. Well, if GDP is 10% less in 2050, then all the young teachers today who are in retirement plans that have diversified portfolios are going to have 10% less for their retirement. So that's what I'm talking about when I say, from the shareholder's perspective, you can't just look at individual company enterprise value. You have to ask the question, how will my company's performance affect the economy? And right now, it's not just disclosure rules, by the way, it's fiduciary duties, particularly at the company level, but also at the trustee level, that make trustees and directors feel as if all they can focus on is enterprise value. And there's a lot of work that could be done to clarify those rules, to make it clear that acting in the interest of shareholders or acting in the interest of pension fund beneficiaries incorporates this broader idea of what shareholder value is.
Thank you. Dr. Palladino, I actually don't remember ESG being in the title of this hearing, but certainly shareholder primacy was. What has been the trade-off in terms of corporate investment in research and development over the last 10 or 20 years with the rise of shareholder primacy?
It's a great question. We know overall that there's opportunity costs when corporations are focusing their financial assets and their energies on raising share prices. We know that CEOs today, many of them themselves, say that they feel hamstrung by the need to constantly appease outside activist investors who are demanding constantly higher share prices. They'd rather be focusing on the types of innovations that their companies are best able to achieve. So I'll just give you a quick example. GE is a paradigmatic example from the 20th century of an innovative company. It's personal to me because it's where my grandfather worked. He was a prisoner of war who then returned to work in aviation at GE in Lynn, Massachusetts. Never had a chance to go to college, but had a good job in which he was part of the process of innovation at his firm. GE turned towards Wall Street, turns towards maximizing shareholder value as its main focus in the 80s. And I think probably many people know the story from there. The focus on share prices caused the innovative potential that was there within the company to decline. Ultimately, we know that GE lost $400 billion in market value over a decade since 2000, leading to 2010. And we know that that focus on shareholder value ultimately took them away from what they should have been doing, which was focused on producing more innovative products over time.
Dr. Palladino, is it fair to link the dismal productivity increase rate of the last 10 years, 2010 to 2020, with the share buyback and the supremacy of stockholder value?
Absolutely. I think that while there are, of course, many factors, because the economy is complicated, I think that the fact that we have not seen investment in the workforce and the American people who actually produce the goods and services that our leading companies make, that investment is what will increase productivity over time. We know that from history, we know that empirically. And that lack of investment is, in my view, the most important opportunity cost of shareholder primacy.
Thank you very much. Ms. Samuelson, you wrote that, and I think this is a really important point, because I want to suggest that corporations are not inherently evil. It sounds like we're bashing them for rebuying, stock repurchases and the like. But let me quote you. You said corporations are amoral. They're just a function of the rules and protocols and incentives that drive behavior.
Right.
And that we license corporations to create goods and services. Deeper than that, and I know you're a student of this, the creation of the corporation was to limit the liability of the people that were investing in it. There were all kinds of benefits that flowed from the rule of law around the corporation that implied a trade-off between their special status, their special protection, and their responsibility to society at large. Can you talk about those rules and protocols?
Well, the most dominant one I spoke about a little bit earlier, I can't remember if you were in the room or out of the room when I did, but it's really about how we tethered CEO pay to the stock price. So the dominant measure today that is used in the market is TSR, total shareholder return, and it's basically made up of two things, dividends, and then these share buybacks, the repurchase of shares, which means some shareholders exit, and the ones who are left, it pops up the stock price by reducing the number of shares outstanding. The valuation is still the same, but the ones who are still there realize a gain. And that's what these investors want. I think the tricky part about this is not, the public company is in massive decline. I think we have 50% as many public companies as we did something like 10 or 15 years ago. And they're in decline not because of kind of ESG investors, so-called ESG investors, which is really just this heightened moment now where investors of all kinds are starting to raise fundamental questions about risk and expressing, if you will, their desire for kind of clarity about what they're investing in. What is it actually realizing? And is it addressing, are these companies addressing the kinds of concerns that people have as investors as well as citizens? I just think all these questions take us back to who will hold this system accountable. Corporations, as you said, corporations were created initially to kind of do the kinds of things you can't do with just your family's resources or those of your best friends. It's essentially it's kind of a bundle of contracts, or it's a way to hold together relationships. And yes, ultimately, they were also given limited liability so that they're not vulnerable to the same kinds of demands as executives would have been otherwise. And so, we're back to the question of kind of really who holds these powerful institutions accountable. I'm a big believer in business. I truly don't believe that we can solve our most complex problems without business at the table. I very believe in what Mr. Alexander's been talking about in terms of the need of the whole market to work well, not just creating the space where individual companies excel. But I think it gets back to the question of who's really holding the system accountable. And frankly, investors are not going to do it. Investors are very, very inclined toward, price and convenience, just like the consumer is. They want it both ways. And I think today what's the most interesting thing on the kind of horizon is the degree to which employees have become a force here, where they're actually raising their voice and asking questions about what are we actually in the business to do? Are we doing it well? What does it look like? And what's my piece of this kind of puzzle? And so I think it's kind of an interesting time to be having this conversation, and we're hopeful that some of these questions that we're asking today will start to kind of align with the questions that executives themselves are asking about what job they have, as well as the investors, the questions investors are asking and employees themselves are asking.
Yeah, thank you. Dr. Rao, in your testimony, you talked about the surge in average household income since 1950, whatever, and then followed it up with the percentage increase in the average income for the lowest quintile, the lowest quartile, which were impressive numbers. How do you reconcile that with the alternative reality that our income and wealth inequality has not been this great in 100 years? And that many sociologists and others suggest that the deep divides in this country today is driven more by the income and wealth inequality than anything else.
Okay, thank you for the question. So I think that income inequality is often overstated by academics. I trust people who have direct access to all the data in government. Auten and Splinter. Auten is at OTA, U.S. Treasury, and Splinter is at the Joint Committee on Taxation, JCT, right here. And so when you incorporate additional assumptions like changing marriage rates and also various alternative sources of income, including transfers from the government, the top 1% share of pre-tax income has only increased 3% since 1962. So primarily, I believe it is not an accurate narrative, and these are also figures from the CBO. It's actually interesting that most of the studies that show that income inequality has not increased that much actually come from government sources, whereas the ones that say it's increased by a lot more are coming from academics. So that's how I would reconcile those things.
Okay, thank you. It's certainly an interesting and lone voice, but thank you. Mr. Alexander, having come out of corporate law and for all that time, one of the things that we've talked about was the notion that the SEC for years and years and years had regulated whether a corporation could use its excess capital for stock buybacks. And some years ago, my history's not good enough to tell you, it was early 1990s, whatever, that rule was changed and thrown out, so the corporations were given essentially a free decision on buybacks. Does it make any sense? Would it help us at all to restate that SEC regulation?
Thank you for the question, and I'm not going to guess at the year because there's a real expert on stockholder buybacks on the panel, so I don't want to be embarrassed.
We can yield to her if you'd rather.
But I will say absolutely. Here's the way I express the problem of the buyback, and again, I'll put this in the terms of thinking about the shareholder at a single company versus thinking about the fact that shareholders are actually diversified, and what they care about is how a company's decisions affect the entire market. And if you think about companies as value enterprise only, it's easy to just return cash to your shareholders because they get 100% of the cash and they can do what they want with it. Whereas if you reinvest in your workforce, in R&D, in new drugs, in electric vehicles, whatever, your shareholders benefit from that, but so does the economy. It's what economists call a spillover effect, right? And some people say, 2/3 of the benefit of reinvesting goes to spillover effect. So it's harder for a company to do that. And I think as regulators, as policymakers, you have to be cognizant of that risk. For my part, I think a lot of this can be solved by changing, and this is what I've been talking about today, changing the rules to make investors, shareholders, think more broadly and not sort of allow them to just focus on single companies, or at least to give them the tools to not just focus on single companies, because that's kind of what they're forced to do today. And that will help with the buyback issue. But I would also just say, because of the different way, the natural tendency of a company to do a buyback because 100% of the value flows to that single company, it's important for all the policies, be it tax, securities regulation, to be very cognizant of that issue, as well as, and this is a different issue, but also an important issue, the potential for corporate insiders to manipulate the market, because they may know when the buyback is coming, and they have lots and lots of stock, and they can sort of play games.
Great, thank you. Dr. Palladino, among the many things written about shareholder primacy is the idea that CEOs and C-suite folks are rewarded in their pay plans. I think you actually write that one of the ways that shareholder primacy is maximized is to make sure that top management's pay is driven by shareholder price. And Elizabeth Warren has had an interesting bill, I don't know if she'd introduced it in this session, that would postpone the ability of top management to cash out their options until they had left the corporation by 3 years, 5 years, something like that. So essentially, they weren't dependent on stock price, a buyback today, a share price surge tomorrow, and divesting of their stock the day after. Is this meaningful? Is this fair? Is this good policy?
Absolutely. Thank you for the question. So just on the point of stock buybacks, one of the harms that they pose is that they do create this incentive structurally for corporate insiders to personally profit, as you've said and as Rick said. And I think that the broader story that we've seen over the last several decades of executives being rewarded by stock and then the stock sort of compensation becoming more and more complex and more able, therefore, to be manipulated by different types of corporate financing maneuvers is a huge problem. And I do think that it's important to reiterate, this is a type of problem that can be easily solved by rules. Corporate executives are not, this is not a story of one single sort of greedy executive over here. This is a problem that we've created through, for example, Rule 10b-18, which is the Securities and Exchange Commission rule that was passed in November of 1982, that essentially allows stock buybacks to happen at essentially an unlimited rate because the SEC does not collect the type of data that would allow them to actually know if companies are staying inside what they've constructed as a safe harbor, and it doesn't presume any liability for stock buybacks outside of that safe harbor in any case. Before 1982, stock buybacks didn't happen that much because they were presumptively understood as manipulating the stock price of the company, which we would see as reasonably problematic in securities markets that we want to be operating and efficient. So I think that this incentive that stock buybacks has created for corporate executives to be able to and incentivized to really use short-term choices or directions of corporate funds in order to reward themselves has turned us again away from innovation, which I think should be our North Star. And I also think that the rules that govern stock buybacks, I'm really happy to see the Securities and Exchange Commission propose Rule SR, which will be, I think, a good first step towards disclosure of stock buybacks. And I really encourage them and the Congress, this body, to go further and join other advanced capital markets around the world to have common sense rules in place because of this fundamental risk of market manipulation and incentives for management.
Thank you very much. I think this question is for Ms. Samuelson, but if you want to defer, we had a hearing some time ago at which, or maybe it was a conversation with one of our many, many terrific economists, that essentially the 7 people that ran the 7 largest index funds, think Fidelity, Vanguard, or the like, were running our country. That they had an enormous number of the stocks under their direct control. Clearly, those may be the people that have a responsibility to maximize shareholder price, since they're, or not. How do we change the incentive system for them? Or is the incentive system right for them? Are they part of the solution?
Well, I think I'd address first the assumption that what are they actually doing with this incredible market power that they have? I think the numbers usually tossed around that BlackRock, which is the largest of the large, I think that they own something like 7 or 8% of virtually every publicly traded security. They are the ultimate universal investor. They can't exit. They have to own the market. And so they have actually limited ability to influence corporations directly because they have thousands, they have probably hundreds of annual meetings during season every day, and they have a limited number of staff who are really detailed to kind of directly engage with corporations. So I think in some respects, they mostly, BlackRock is one that would have been criticized for this. They mostly just vote with management. They vote with, they vote with whatever management wants on proxy votes. They've started to step back from that on some issues that, kind of are critically important. I mean, climate change being one of them. But it's not that obvious what they can do as an indexer. And so I think it takes us back to kind of saying, what are the expectations of investors? And it takes me back also to this other question about how we pay executives and what the expectations there are, because Elizabeth Warren's proposal would suggest that it's just a matter of time frame, and that loading up executives with stock, which in some respects the BlackRocks of the world like, right? Because that means that that they're, in theory, that those CEOs are very, very attuned to pumping up the stock price. And of course, there's an awful lot of that going on. But if you're a BlackRock or a Vanguard, you want the whole portfolio to do well. It doesn't really do this good, just as Rick's been pointing out, to kind of focus in on one stock or the other. So if I were writing that law, I'd be pulling back. Not that Congress necessarily has the power to do this, by the way. There's more power that resides within executives to fix their own stock, maybe, than Congress doing it directly. We've learned this from past experience. But I'd pull back from the emphasis on stock. I don't think it's doing us any good. You hire these executives, they have, they're people that have to exercise extraordinary judgment. They don't need incentives to take seriously the kind of risks that they're facing in this remarkably complicated day and remarkably complicated market. And I don't know why we have to kind of load them up with stock in order to head them in the right direction. They care ultimately about the health of their enterprise, as they should. And they should care about, if not everything that one might call a stakeholder, I don't particularly like that term, they have to get the formula right. They've got to manage their enterprise for the long haul. And that means being very attuned to what's the input that matters the most if I'm an Intel, or what's the input that matters the most if I'm Chevron or Exxon. Those are going to come up with different answers. And what we want is executives who actually are, well compensated, that's fine, but who have kind of a sense of where they fit into the larger market, not doubling down, tripling down, quadrupling down, to have them just focus on the stock price.
Thank you. Let me ask one more question. I think for Mr. Alexander, from your corporate legal background. I'm a big fan of Thomas Philippon, who French economist, teaches at NYU, who wrote The Great Reversal, which is the best damning indictment I've seen yet of the corporate concentration, which I think Ms. Samuelson mentioned earlier. Hasn't the stock buybacks dampened corporate concentration? Wouldn't it be worse if corporations were forced to hold their capital and simply buy other smaller companies with it? Or how do those interact, or is it too complicated to talk about?
I think I'm going to say that I'm probably not a good person to answer that question. I'd love to talk a little bit about BlackRock, but you're the chair, so
Dr. Palladino, any insight into the interaction between shareholder primacy and the failure of antitrust since Milton Friedman?
Absolutely. I think, we could have a whole other hearing on this question, and maybe we should. I think that within the theory that says that we need competitive markets, we've forgotten that, I teach introductory microeconomics, probably Dr. Rao does sometimes too. We have to talk about questions of market power. We have to talk about questions of externalities. These are the assumptions that we wave our hands and say don't exist when we're coming to this point of believing that perfect market clearing will simply occur. I think that the rules that have been set in place that have enabled shareholder primacy are fundamentally related to the same drivers that have increased corporate concentration, the same interests that have driven us away from a focus on innovation have made some of our largest companies focus as well on maintaining market power through the exact types of practices that our antitrust laws were first set up to take on. So while there's a lot of difference in terms of the regulatory structures that govern state corporate governance law and federal antitrust law, I believe it's really in the interest of the American people for regulators and those of us scholars and others on the panel to think more about the right balance between innovation and really constraining the types of anti-competitive behaviors that our largest corporations have unfortunately too often been practicing.
Great. Thank you very much. They've called the second vote over in the House. I want to thank you for letting me ask rounds 2, 3, 4, and 5. I sort of like this doing ourselves. In any case, thank you all very much for being here. And I want to thank you for joining me in this vital conversation about the economic cost of shareholder primacy. As we've discussed today, increased corporate focus on short-term value prices is a recent phenomenon driven by a model of corporate governance that puts shareholders before workers and innovation in the climate. And the recent pursuit of short-term gains has eroded the voices of workers, many of whom have seen their earnings as a share of GDP diminish over the years, while also exacerbating income, wealth, racial, and geographic inequality, at least with respect to Dr. Rao, according to many economists. Focused on stock buybacks and executive compensation, companies are investing less per dollar of profit in long-term growth and sustainability than they did in the past. And this limits the competitiveness and overall productivity of our economy. Even the average investor is left worse off. The good news is that this is not the only way to do business. Hearing from these experts today, I'm confident that we can once again prioritize investment that drive inclusive economic growth and address complex existential challenges like the threat posed by climate change. We can do this by strengthening the bargaining power of workers and realigning incentives to reward long-term pro-growth investments that generate society and economy-wide returns. And we can do this together. So thank you for each of our panelists for your contributions to this timely and ongoing discussion. As you do this important work, we rely on your expertise and good faith. And thank you to my colleagues who came and went about their business for being part of this discussion and sharing their wisdom. The record will remain open for 3 days. The hearing is now adjourned.